if we're going to bring in one of the top-ranked analysts on Chinese power producers, returning 40% plus for his clients. We have Pierre Lau, head of regional utilities research at Citigroup Global Markets, joining us on this Friday. Good to see you, Pierre. Now, you just saw Stephen Engle reporting on the diversification of China's power use. What about nuclear power and diversification away from coal? How do you see things playing out in the next 5 years or so, and how do you invest on that theme?
Okay, in terms of China electricity generation from nuclear is now only 1%. What the Chinese government is targeting to increase to 4% by the end of 2020. And in terms of investment opportunity, given that it takes a long time for nuclear power plant construction, so we think it's better to play on some nuclear power equipment on nuclear investment phases. And that's why we like a company called Dongfang Electric, which has the majority of the market share in nuclear power equipment.
Okay, now before Steve jumps in here, Steve, let me just bring up the statistics for Dongfang Electric, which is one of Pierre's top buys. Steve, Dongfang trading at 40 Hong Kong dollars a piece. Your target price 47, which actually is above analyst consensus. And as you mentioned, 50% of the PRC's nuclear power equipment market. Steve-o, do you have a question for Mr. Lau?
Yeah, I'm kind of curious on the input side of the equation. Obviously, Australia supplies a lot of iron ore and other raw materials, but also uranium. How do you see the uranium market developing? I know this is a little bit away from your expertise since you're utilities and power generation, but the utility side and the raw materials, do you see a uranium market expanding over this next decade to China from places like Australia, also some of these other peripheral countries like Mongolia, Kazakhstan, and then that comes into the equation as well, though, the non-proliferation issues that some nations obviously are going to have with China's nuclear ambitions?
I think there's no doubt that given that there are more nuclear power project development, not only in China but also in other countries, the nuclear fuel price is going to go up, and this is something negative to nuclear power plant operator. That's why at the moment we prefer the equipment supplier to benefit more in the near term from increased demand in nuclear power plant, and that's why we like the company called Dongfang Electric.
Yeah. Okay. Well, you keep talking about Dongfang Electric, Pierre. Now, just a year ago or so, I think during maybe March or April, you were actually more bullish on the other big power producers in China, such as Datong, Huadian, and the like. But now you're calling these either a sell or maybe just a hold.
Well, the key reason is that since September last year, we have sharp rally of coal prices in China. And since coal prices account for about 70% of their operating expenses for these Chinese IPP, so that's why we have become more cautious on this stock. Yeah,
you become more cautious. So you're saying sell on Datong, Hong Kong China Gas, and Huadian, is that right?
Right.
Okay, well, let's talk about the other buy recommendation that you have, which is China Resources Power. This is also a power generator, I believe. But what makes this a standout as opposed to the other big China power producers?
Okay, there are three differences for this company compared to its peer. The first one is this company will have some extra profit from the commissioning of a coal mine operation in Shanxi province. Second, in terms of the company net profit sensitivity to coal prices, this company has the lowest sensitivities because of the highest net profit margin. And the third one is, obviously, we are expecting interest rate hike in China, and this company has the lowest gearing among its peers.
Yeah, 20 buys, 0 sells. So it seems like there's consensus among analysts on this particular stock. Let's quickly move it on and talk about India, because you have some stock picks also in India as well. What about the, I guess, the performance of Indian shares compared to China shares this year? Quickly.
In general, the Indian stock performed better than the Chinese stock over the last 12 months. The key reason is that most of the Indian power companies are making regulated return, meaning that they could pass through the incremental fuel cost to its customer. And as such, these Indian names are immune from the negative impact of rising coal prices.
Okay. All right, Pierre. Thank you so much for dropping by today. Nice to see you, Pierre Lau of Citigroup. We're going to commercial.